The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello, and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. During the last episode, we spoke with consultant and author Paul Niven, the author of the powerful Balanced Scorecard Step by Step, Maximizing Performance and Maintaining Results. This is episode 18, and we'll be speaking with Tom Copeland. Tom is one of the few people in the world with deep experience and top credentials as a practitioner as well as an academic in financial economics. He received his PhD from the University of Pennsylvania, his MBA from Wharton, and his BA in economics from Johns Hopkins University. Tom's practitioner experience extends over a 31 period. For 11 years, he was co-leader of McKinsey & Company's global corporate finance practice, where he consulted on over 200 companies in 40 countries on topics as diverse as value-based management, mergers and acquisitions, capital structure and cost of capital, hedging, restructuring, and turnarounds. Tom joins us to discuss expectations-based management, or EBM. Tom, welcome to CFO Talk Radio.
Good morning, Robert. How are you?
Oh, terrific. You know, I think most of us have heard the old refrain that some people know the price of everything but the value of nothing. And not to take any cheap shots, but I can't think of a better example of this than maybe the private equity industry from 2003 to 2007, when the pricing of many LBO transactions, they just really seem to be, in my opinion, completely divorced from any reasonable or rational valuation. And I guess, you know, if a gun were put to my head, I guess I could also point maybe to the internet boom of the 1990s, and then naturally the shares of real estate developers more recently. I mean, so I'd like to ask you, number one, do you think that this is a fair observation on my part? And assuming so, what drives otherwise, you know, really highly intelligent and experienced professionals to ignore or abandon, you know, what we've really been trained are the fundamental tenets of corporate finance?
Well, I wish I had a rational explanation for this kind of behavior. You're pointing to situations which, from a rational point of view or a discounted cash flow point of view, were bubbles, both ex ante and ex post. And there's no rational explanation for why these bubbles occurred, although you can identify them as they're occurring. What I do is I use discounted cash flow valuations of companies. I have an expert system that does that for me very quickly, and you know, I can identify companies that I think are over or undervalued using that system.
Well, yeah. Again, what kind of bothers me is we're not talking about, especially in the case of LBOs, we're not talking about your average person walking down the street making a mistake in terms of buying a stock or a mutual fund at an inflated price. We're talking about people, particularly in the private equity industry, that really should be professionals in the art of valuation. So it's really kind of that in particular has really astounded me. But, you know, perhaps human behavior, you know, in a bubble just, you know, it eludes me. But in any event, oh, go ahead, please.
Well, I was going to say, if you look at the mortgage-backed securities market, experts, Bear Stearns and Lehman went bankrupt over the bets that they were making in markets that were highly inflated, I thought.
Right. Well, I guess I would point to the individual traders as saying, okay, well, these guys make their money based on bonuses. So if they blow up the company, they probably don't have any money, you know, at risk. Whereas I would like to think, perhaps I'm wrong, that the private equity players invest in their own funds, and you'd think that they would have, some sort of long-term interest in the performance of their company. Whereas, again, in my mind, and I could be mistaken, when I think of traders, I think of people who have very, very short-term time horizons. But private equity, at least on a traditional basis, they've held their portfolio companies for a matter of years.
It's always a two-edged sword. I had a good friend. His name was James Guy, who was working at Lehman. In fact, the bond index that they have was his invention back in the 80s, and he was in charge of their bond portfolio. You may remember in the early 80s there was double-digit inflation, and he took the whole portfolio from short-term bonds to long-term bonds, giving up at 500 basis points in interest, and then the inflation went out of the market, and the long-term bond prices skyrocketed, and he recorded the largest capital gain in the history of the company up to that point in time. Later in New York, I had lunch with him. He paid, of course. And was more or less giggling all the way through lunch. And I asked him, we'd been friends for a long time, I asked him, how did you make that bet? It was quite a risky thing to do. You were giving up a lot of income. And he looked at me and he said, I guessed. He had a PhD in financial economics from the University of Pennsylvania. I had been a professor at Berkeley and head of the bond portfolio at Lehman, and he guessed. It was the right guess.
Right.
But I think that when you're living in a world of uncertainty, there's plenty of room for error.
Right. Right. But in his defense, I'm sure that he says he guessed, but that was basically an educated guess. And if I recall correctly, I may be wrong. I remember looking at the time, if we talk about interest rate environments, I remember looking at a used car loan and had decent credit myself. I want to say that the used, and this is on a secured basis, were mid 20%. So I think sometimes we use sophisticated tools to explain an anomaly when most of us can simply step back and say, okay, let's look at this from the context of history and the context of economic and market cycles. Is this interest rate environment sustainable over the long term? And then I think that your friend, based with his experience and his incredible education, is going to say, no, it's not. And so therefore his guess, although he may not have used sophisticated models that we in finance, and I think all of our listeners as members of corporate finance teams, we tend to rely on. But sometimes I think the tools can be a little bit misleading because the focus is so narrow, and we need to step back and look at things from a broader context. Do you think that's fair?
Yeah, I do, and that's a good segue into the rest of our conversation, I think.
Well, good. Then let's pursue that, because now that we've really identified, and I think that we all recognize and agree that a lot of times, whether it's the tools or it's human nature, a lot of times price and valuation are separate, and they have, although they should be highly correlated and there should be a tight relationship, sometimes that just breaks down. And so you and your co-author, Aaron Dolgoff, authored a book entitled Outperform with Expectations-Based Management, a state-of-the-art approach to creating and enhancing shareholder value. And so what I'd like to know is, what is EBM, and how can the corporate finance professionals use EBM to maybe help them make better CapEx investment and business mix decisions?
Well, I think the short statement is that EBM is an attempt to tie performance measurement within a company directly to the shareholder returns in the market. the difference between expectations-based management and other measures is that in order for the shareholders' returns to be positive, it's necessary to beat expectations. For example, in 1998, in October of 1998, Intel announced that its earnings were up 19% over the year before, and you would expect that the share price would go up on that announcement. But in fact, the share price went down about 6%. The reason was that the market's expectations were for about a 24% increase over the year before, and when 19% was announced, the market was disappointed. Therefore, the price went down because expectations were not met. Expectations are an important part of linking a performance measurement internally inside the company to what we actually see in the stock market.
All right. Well, let me summarize, and you tell me if I understand correctly or not. But fundamentally, the stock price of any company represents, the discounted cash flow of our expectations of that company's earnings on a per share basis and cash flow and that type of thing. So any cash available to the shareholders is then discounted and baked into the share price. So it's not so much past performance, although past performance may suggest future performance. And so I guess with EBM is a tool for us to maybe reverse engineer and identify those expectations of our investors and give us some sort of guidelines in terms of our internal targets or hurdle rates. Is that right, or do I misunderstand?
That's right. Yeah. Another example would be before it went bankrupt, Bethlehem Steel had a cost of capital of 9 or 10%, and was earning a rate of return of 4 or 5%. So you'd see, most people would say that they were destroying value because their return was less than their cost of capital. But that ignores expectations. If the market was expecting 4 or 5% and they earned 4 or 5%, the price was about right. But if they earned 8% on an unexpected increase in return, even though it was less than the cost of capital, the stock price would increase.
Well, let me ask you this. We had just a few months ago, we had the opportunity to speak with Justin Pettit of Booz & Company about the state of value-based management, and he had worked in a prior life with Stern Stewart, which of course popularized and invented economic value added, or EVA. Mm-hmm. When we look at EBM, is it fair to compare it to maybe EVA and total shareholder returns?
Yeah, in fact, it is. You can think of it as being the next generation of thinking about this point. EVA, for those in your audience who aren't familiar with it, is the difference between the return on invested capital in a company and its weighted average cost of capital. So that's the spread over the cost of capital, mm-hmm. times the amount of capital invested. The difference between EVA and EBM is that EBM takes the difference between the actual and expected return on invested capital times the amount of invested capital, and you call that the value created by operating your existing assets more efficiently. Mm-hmm. And then it has a second term, which is the difference between the expected and actual weighted average cost of capital. So that if the financing officers are able to reduce the cost of capital to be less than expected, that can create value.
Right. Well, actually,
and then
go ahead.
There's just one more term, and that is that if you take the return on invested capital minus the weighted average cost of capital, and multiply that by the difference between the amount of capital that was expected to be invested versus what was actually invested, you have a third term, which is basically the value created by new investment.
Mm-hmm.
So the three terms are the first term is doing better than expected on your legacy assets or your existing assets. The second one is doing better than expected with financing, and the third term is doing better than expected with new investment.
Okay.
So each of those terms adds expectations to each of the three terms in the Stern-Stewart EVA.
Right. So if we were looking at traditional value-based management, we'd say that the three main levers for VBM are going to be the amount of capital that you have employed, the cost of that capital that you employ, and then of course your profitability or your margins, your return, basically. And with
on existing assets,
is that correct?
Yeah. Mm-hmm.
Right. And so EBM recognizes, yes, that's true, but there are also expectations with regard to how much capital you'll employ, whether or not that's what you actually employ, and then the expectation regarding to the cost of capital, which is separate from perhaps the reality, as well as margins. And so by kind of reverse engineering or disaggregation, we can understand what the market anticipates from us.
Right. It basically is performance versus expectations in those three areas: legacy assets, financing, and new investment.
Well, if we could, let's talk about the process of adopting an EBM program. What does the process of adoption look like? And when advising companies, about to adopt EBM, what advice and suggestions do you provide to senior leadership to really best prepare them for the challenges that the adoption process is almost certain to present? Because I know that in the past, certain shareholder value, programs were too quantitative, meaning that some of the staff outside of the financial suite just didn't get it. Is that a problem with EBM, or is there a way that we can best manage that?
I think it's fair to say that it is an issue, and the way that I deal with it is I first contrast the new EBM measure with existing measures. For example, why earnings per share or the growth in earnings per share are flawed because they don't contain any information about managing the balance sheet. And why return on invested capital minus weighted average cost of capital is flawed because it encourages harvesting the business. And so the first step is understanding why conceptually EBM is better tied to the share price than any of the existing measures. And then the second part of the learning is that there's been a lot of academic evidence that's been published in the best journals, which confirms that in fact the measure that has the best empirical link to shareholder returns is EBM and not the others. And then once top management starts to become comfortable with using the measure, then we generally roll it down through the company, either through if the company is functionally organized through the functions like marketing and production, or if it's organized into business units by valuing each business unit and calculating the measure as well.
Okay, so we start at the top and we try to naturally get buy-in from the senior executives and the heads of the various business or functional units, and then cascade the measure down as appropriate. So let me move from initial rollout maybe, and let's go to the end of the process. Let's say that we've already rolled it out. At what point, how long do you think is fair to say, okay, we've given the program enough time, now let's step back and let's measure its impact? So again, when do you think it's fair to kind of assess the progress of the program and what its payoff is?
Depends on the intensity with which you roll it out, in my opinion. If you roll it out function by function and business unit by business unit, looking for immediate changes in and improvements in performance on value drivers, so that you start looking to see where you can most easily exceed expectations. The impact can be large and immediate. It's the most detailed way of implementation, however. A lot of companies like to take it one step at a time and just run through the sample numbers at the level of the CFO and discuss them at the board to see if they make sense intuitively as well as mathematically. And then they go from there and roll it out more slowly. But the impact can be enormous if you take the more detailed method when you're ready.
Right. Well, naturally, VBM and EBM are huge and somewhat complex topics. In light of this, what parting advice or suggestions would you like to share that maybe we've not had an opportunity to touch on at this point?
Well, I think the concept is easy enough to grasp, but getting the implementation to actually change the way you're doing business is the hard part and the valuable part. I've seen situations in the days when I was doing consulting where the ideas that were turned up by refocusing business units on the right metrics were in the billions of dollars.
Yeah, that's incredible. Well, Tom, many thanks for joining us today, and I hope you'll join us again soon. Maybe we can have you back to talk about your seminal book, Valuation, Measuring and Managing the Value of Companies, or about another subject that I know that you're pretty passionate about, real options.
I'd love the opportunity, Robert. Thanks for having me.
That was consultant and author Tom Copeland, discussing the importance and principles underpinning his book, Outperform with Expectations-Based Management, a state-of-the-art approach to creating and enhancing shareholder value. Please join us for our next episode when we speak with Gary Kokens. Gary is a manager of global business advisory services involved with performance management solutions at SAS and is an internationally recognized expert on advanced cost management and performance improvement systems. Gary joins us to discuss some of the fundamental principles of activity-based costing and activity-based management. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.